What's going on, everybody? This is Demetrius Harris, your DAC Funding Broker. And on this channel, I help business owners get access to funding in all types of industries. If you own a construction company, roofing company, general contractor business, electrical company, plumbing company, HVAC business, excavation company, concrete company, paving company, or another business in the construction industry, this video is for you. Today, I'm answering some of the most important questions construction business owners ask about funding. How much funding can a construction company receive? What determines the funding limit? How long are the repayment terms? How quickly can a business get approved? What documents are usually required? Can you qualify with imperfect credit? Can funding be used for payroll, materials, equipment, vehicles, and project expenses? Before we get started, make sure you like, subscribe, and hit the notification bell for more funding content. Hey, let's get into it, y'all. Many construction businesses do not fail because they lack customers or contracts. They experience pressure because they must pay for labor, materials, fuel, insurance, equipment, subcontractors, permits, and project expenses before they receive the full payment from the customer. That timing gap is why access to capital can be so important. In this Q&A, I'm going to explain construction funding limits, repayment terms, approval requirements, and funding timelines so you can approach the process with realistic expectations. Funding amounts, rates, terms, approval requirements, and timelines vary by lender and applicant. Nothing in this video should be considered a guaranteed approval or a funding offer. Question 1. What is construction business funding? Construction business funding is capital that a construction company may use to support legitimate business expenses. Depending on the funding product and lender, the money may be used for payroll, construction materials, equipment, tools, fuel, insurance, subcontractors, project mobilization, marketing, vehicles, repairs, permits, rent, utilities, expansion, and general working capital. Construction funding is not one single product. It can include working capital, equipment financing, business lines of credit, term loans, invoice-based solutions, and other commercial funding products. The right option depends on the business, the intended use of funds, the amount needed, the strength of the application, and the lender's guidelines. Question 2. Why do construction companies need working capital? Construction companies often pay expenses before collecting revenue. For example, a contractor may win a large project but still need money to purchase material, mobilize crews, rent equipment, pay subcontractors, and cover payroll before receiving the first progress payment. A company can have signed contracts and strong future revenue, but still experience immediate cash flow pressure. This is not always a profitability problem. It can be a timing problem. Working capital may help bridge the gap between paying project expenses and receiving customer payments. It may also help construction companies take on larger projects without exhausting the cash needed to operate the rest of the business. Question 3. How much construction funding can a business receive? This is one of the most common questions, and the honest answer is that there is no universal funding limit for every construction company. The amount available may depend on monthly revenue, average business deposit, time in business, cash flow, existing debt, bank account activity, personal and business credit, industry risk, requested use of funds, the specific lender or funding product. Some businesses may qualify for a smaller amount to address short-term working capital needs. More established companies with stronger revenue, cleaner banking, and a longer operating history may qualify for larger amounts. The important point is that the funding amount is usually based on the business ability to support the obligation. Requesting a large amount does not automatically mean the business will qualify for their funding. Lenders normally want the approved amount to make sense relative to the company's revenue and cash flow. Question 4. What determines the funding limit? The funding limit is often determined by the overall strength of the business. Let's break down the main factors. Monthly revenue. Lenders want to know how much money the business consistently generates. A business producing stronger and more consistent revenue may be able to support a larger funding amount than a business with limited or inconsistent revenue. Business deposits. Lenders may review the amount and frequency of deposits entering the company's bank account. Consistent deposits may demonstrate active operations and stable cash flow. Time in business. An established construction company may present less risk than a newly launched business with limited operating history. Time in business does not guarantee approval, but it can influence available products, terms, and funding limits. Cash flow. Revenue alone is not enough. Lenders may also look at how much money remains after the company pays its regular expenses. A company generating significant revenue but operating with extremely thin margins may not qualify for the same amount as a company with healthier cash flow. Existing debt. Current loans, advances, equipment payments, vehicle payments, and other obligations can affect how much additional capital a company can support. Credit profile. Depending on the product, lenders may review the owner's personal credit, business credit, or both. Credit is important, but it is often one part of the full underwriting picture. Question 5. Do construction companies need perfect credit? No. Every construction funding option does not require perfect credit. However, credit can influence approval probability, available funding products, funding amount, interest rate or cost, repayment term, required documentation, whether collateral or a personal guarantee is required. A stronger credit profile may open access to more competitive options. A business owner with imperfect credit may still have possibilities when the company has established revenue, consistent deposits, stable cash flow, and a strong operating history. The mistake is assuming that credit does not matter at all. Credit may not be the only factor, but it can still affect the structure and cost of the funding. Question 6. What are the typical repayment terms? Repayment terms vary significantly depending on the funding product. Some short-term working capital products may be repaid over a shorter period with more frequent payments. Traditional term loans may provide longer repayment periods and scheduled monthly payments. Equipment financing terms may be connected to the cost and useful life of the equipment. A business line of credit may allow the company to draw funds as needed and repay only the amount used, subject to the lender's terms. Before accepting any offer, construction business owners should understand total funding amount, total repayment amount, interest rate or factor rate, payment frequency, payment amount, repayment period, origination or administrative leave, prepayment provisions, personal guarantee requirements, collateral requirements, default provisions. Do not evaluate an offer based only on the payment amount. A lower payment may come with a longer term and a higher total cost. A shorter term may have larger payments that place more pressure on weekly or monthly cash flow. The best option is one the business can reasonably support. Question 7. Are payments daily, weekly, or monthly? The payment frequency depends on the funding product. Some products may require daily payments, weekly payments, bi-weekly payments, monthly payments. Monthly payments may be easier for some construction businesses to manage, especially when customer payments arrive on a predictable schedule. However, certain working capital products may use daily or weekly payments. Construction company owners should compare payment frequency with how their businesses collect revenue. If customers pay the company every 30, 45 days, or 60 days, a high-frequency repayment schedule may create additional pressure. Always evaluate whether the payment structure aligns with the project and collection cycle. Question 8. How fast can construction funding be approved? Approval timelines vary by lender, funding type, application quality, and documentation. Some working capital products may provide a decision quickly when the business supplies complete information and meets the lender's requirements. More complex products, larger requests, equipment transactions, or traditional loans may require additional underwriting and take longer. Factors that can affect the timeline include missing documents, incomplete applications, unverified business information, credit issues, inconsistent deposits, ownership verification, large funding requests, equipment appraisals, collateral review, additional underwriting questions. A quick initial response is not always the same as final approval or funding. The timeline usually includes several stages: application submitted, documents reviewed, underwriting completed, offer presented, agreement signed, final verification completed, funds dispersed. Business owners should avoid assuming that every application will be funded within the same time frame. Question 9. How can a business speed up the process? Preparation is one of the best ways to reduce delays. Before applying, construction company owners should gather the documents that may be requested. These may be government-issued identification, business bank statements, voided business check, business formation documents, employer identification number, proof of business ownership, tax returns, profit and loss statement, balance sheet, accounts receivable report, existing debt information, equipment invoice or quote, project contracts or invoices, proof of business address. Not every lender will request every document. However, having complete and accurate information available can prevent unnecessary delays. Make sure the business name, address, ownership information, phone number, and bank account details match across the application and supporting documents. Even small inconsistencies can slow down verification. Question 10. What documents are normally required? Documentation depends on the product. A revenue-based working capital application may focus heavily on recent bank statements and business revenue. A traditional loan may require tax returns, financial statements, debt schedules, and additional records. Equipment financing may require a vendor quote, equipment description, serial information, or invoice. Larger funding requests may receive more detailed underwriting than smaller requests. The safest approach is to maintain organized financial records throughout the year instead of waiting until capital is urgently needed. Question 11. Can a new construction company get funding? New construction companies may have fewer options because they have limited revenue history and fewer financial records. However, availability depends on how long the business has operated, current revenue, owner credit, industry experience, available collateral, signed contracts, equipment being purchased, the specific funding product. A new business should not assume it will qualify for the same amount or terms as an established company with several years of consistent revenue. Newer businesses may need to start with smaller amounts, build business banking history, improve credit, and establish consistent revenue before qualifying for larger facilities. Question 12. Can funding be used for materials? Depending on the lender and funding product, Construction funding may be used to purchase materials such as lumber, concrete, roofing materials, electrical supplies, plumbing materials, flooring, steel, asphalt, drywall, fixtures, paint, fasteners, and safety supplies. Material cost creates consistent cash flow pressure because suppliers may require payment before the contractor receives money from the customer. Working capital may allow the company to purchase materials, begin the project, and avoid delaying work while waiting for customer payments. Business owners should confirm permitted uses before accepting funding. Question 13. Can construction funding cover payroll? Yes, certain working capital products may be used for payroll. Payroll is one of the most common reasons construction companies seek capital. A contractor may need to pay employees and subcontractors every week while waiting several weeks for a customer or general contractor to release payment. However, funding should not replace proper project pricing and cash flow management. If every project consistently creates a payroll shortage, the company may need to be examined. Bid accuracy, labor costs, gross profit margins, customer payment terms, change order management, project scheduling, deposit requirements, billing procedures. Funding can help bridge a timing gap, but it cannot permanently fix an unprofitable pricing structure. Question 14. Can funding be used for equipment? Equipment financing may be available for construction assets, such as excavators, skid steers, bulldozers, backhoes, dump trucks, trailers, cranes, concrete equipment, compressors, generators, scaffolding, power tools, and specialty machinery. The equipment may sometimes serve as collateral for the financing. Approval may depend on the equipment's age, condition, cost, expected useful life, vendor, and resale value. The owner's credit and business financial profile may also be reviewed. Question 15. Should a contractor use working capital or equipment financing? The answer depends on the need. Working capital may be appropriate for flexible expenses such as payroll, materials, fuel, insurance, marketing, rent, utilities, multiple project expenses. Equipment financing may be more appropriate when the business is purchasing a specific vehicle, machine, or piece of equipment. Using equipment financing for a major asset may help preserve working capital for payroll and operating expenses. The best strategy is to match the funding product to the expense. Question 16. What is a business line of credit? A business line of credit may provide access to a revolving amount of capital. The company can draw funds when needed, repay the balance, and potentially reuse the available credit, subject to the lender's guidelines. A line of credit may be useful for unexpected repairs, material purchases, short project gaps, seasonal slowdowns, emergency payroll, smaller recurring expenses. It may offer more flexibility than receiving one lump sum loan. However, approval limits, fees, interest, draw requirements, and repayment terms vary. Question 17. What if the company has slow-paying customers? Slow customer payments are common in construction. A company may complete work but wait weeks or months for final payment. Possible solution may include working capital, a business line of credit, invoice financing, accounts receivable financing, better customer deposit requirements, progress billing, more frequent invoicing, stronger collection procedures. Invoice-based funding may depend on the quality of the invoice, the customer responsible for paying it, and whether the work has been completed and accepted. Not every invoice will qualify. Question 18. Can signed contracts guarantee approval? No. Signed contracts may support the application by showing expected work, but they do not guarantee funding. Lenders may still review current revenue, deposits, cash flow, credit, existing debt, customer quality, contract terms, project risk, business history. A contract represents expected revenue, but the lender may want evidence that the company can successfully complete the project and manage the repayment obligations. Question 19. What can cause a construction funding application to be denied? Common reasons may include insufficient revenue, inconsistent deposits, too little time in business, excessive overdraft, negative bank balances, high existing debt, poor credit, unverifiable business information, excess recent funding inquiries, incomplete documents, tax issues, weak cash flow, requested amount too high, restricted use of funds, industry or lender policy restrictions. A denial does not always mean the business will never qualify. It may mean the business needs to improve specific areas before applying again. Question 20. What should a business do after a denial? Ask for the reason when possible, then focus on the issue that affected the decision. That may mean increasing revenue, building more time in business, reducing overdrafts, paying down existing debt, improving personal credit, correcting inaccurate credit information, separating business and personal finances, maintaining stronger bank balances, organizing financial records, requesting a more realistic amount. Do not immediately submit applications everywhere. Multiple uncoordinated applications may create additional inquiries, confusion, or overlapping offers. Question 21. How should a construction company choose a funding offer? Do not choose any offer only because it provides the largest amount. Compare funding amount, total cost, payment amount, payment frequency, repayment period, fees, prepayment provision, collateral requirements, personal guarantee, impact on cash flow, intended return on the funds. Ask whether the funding will produce enough value to justify the obligation. For example, using capital to purchase materials for a profitable contract may make business sense when the project margin can support the financing costs. Using expensive short-term capital for an uncertain expense may create unnecessary risk. Question 22. How should funding be used responsibly? Construction funding should be connected to a clear business purpose. Before accepting capital, know exactly how much is needed, where the money will go, how the funding will generate or protect revenue, how payments will be covered, what happens if a project is delayed, whether the business has a backup repayment plan. Do not take more capital than the business can reasonably use and repay. Funding should strengthen the company, not create a payment structure that drains operating cash. Question 23. When is the best time to apply? The best time is usually before the business reaches a crisis. Do not wait until payroll is due tomorrow, the bank account is overdrawn, a supplier has stopped extending credit, equipment has already failed, a project has been delayed, insurance is about to lapse. A business may appear stronger when it applies with stable revenue, positive balances, consistent deposits, and organized records. Funding is often easier to evaluate when the company is stable rather than already under extreme pressure. Question 24. How can construction companies improve their approval odds? Construction business owners can strengthen their funding profile by keeping business and personal finances separate, depositing revenue into the business account, reducing overdraft, maintaining accurate bookkeeping, filing taxes on time, monitoring personal and business credit, paying existing obligations as agreed, keeping licenses and insurance current, knowing monthly revenue and expenses, maintaining project contracts and invoices, requesting a realistic amount, explaining the use of funds clearly, applying before the need becomes an emergency. Strong financial discipline does not guarantee approval, but it can improve how their business appears during underwriting. Question 25. What is the most important thing to remember? Funding limits, terms, rates, requirements, and timelines are not identical for every construction company. Two businesses in the same industry may receive different results because their revenue, credit, cash flow, debt, time in business, and bank activity are different. Do not compare your potential approval to another contractor's approval without understanding the full financial picture. The best approach is to review your company's actual situation and identify the option that fits your needs and repayment ability. Now here's a final recap. Let's review the main points. Construction funding may help with payroll, materials, equipment, fuel, subcontractors, repairs, project mobilization, and growth. The funding limit may depend on revenue, deposits, time of business, cash flow, debt, credit, and the funding product. Repayment terms may be short or long and may involve daily, weekly, or monthly payments. Approval and funding timelines vary depending on the product, lender, requested amount, documentation, and strength of the application. The faster you provide accurate and complete documents, the easier it may be for the application to move through underwriting. Most importantly, choose funding that fits the business' actual need and repayment capacity. If you own a construction company and need funding for payroll, materials, equipment, project expenses, working capital, or expansion, use the funding link in the description to explore available options. Remember that approval, amounts, rates, terms, and timelines depend on the lender and the strength of the business application. Make sure you like, subscribe, and hit the notification bell for more funding content. And subscribe to my YouTube channel at Demetrius Harris 1975. I'm Demetrius Harris, your DAC Funding Broker, and I help business owners access funding in all types of industries. Thank you for watching, and I'll see you in the next video.